All right, so we're on our last risk here, currency risk, and then we'll start a new section, which is some of the leading thinkers in risk management. So currency risk, one of my least favorite risks because I just don't like dealing with currencies. I always have to stop and think which way I'm going, which currency is being divided by the other. It is a challenging, for some reason, mentally challenging issue for me for currencies. It's just been one of my weak spots in finance. Um, but how do you define it? It's the change in a currency impacts your revenues, your expenses, your assets, and a little bit of liabilities differently, such that you either lose money or you lose net worth. How do you measure it? Value at risk, again, is the most common approach. You run different simulations, you use history, different assumptions, and you're trying to figure out what could be the worst case for a currency going up or down relative to another currency. If your business is all in the U.S., then you maybe don't have this risk. But if you have overseas, if you're buying from overseas, or if you're selling overseas, or if you have assets that are in overseas, even if you have an international portfolio of stocks, you're going to be exposed to some currencies. Currencies are probably hitting most people in some way. But value risk is just the most common approach. How do you mitigate it? Well, currency derivatives like swaps and options and futures are very, very, very liquid. There are very good firms that know how to manage this, and so these are not difficult trades. You can definitely, if you get an account at a broker, you can do some paper trades to practice with currencies. They're not difficult transactions to do, but you better know what you're doing because currency can be very unpredictable and very volatile. Um, so my experience on currencies, so USA had a small exposure to the UK pound and to the euro because USA, anytime USA mainly sells to military, and so when military personnel were stationed overseas, USA would provide them homeowners and auto insurance. And because they were overseas, we collected um, their premiums in euros and pounds, and then we paid claims in euros and pounds. It was a small exposure, was maybe 100 million, $200 million worth of exposure, really small exposure, but it was still a risk that did come through USA's balance sheet. Someone needed to manage it, and usually on things like that, they came to my desk. Anything no one else wanted to do that was any way related to finance usually came to me. I was a catch-all for all these small projects. And so it came to my desk. As much as I hate currencies, I don't like dealing with them at all. So the way I did it is I set it all up in Excel to make it foolproof, so I would know exactly which way I was supposed to go on the currency trade. So we had revenues that we collected in foreign securities, in foreign currencies, and we had assets in foreign currencies, we had liabilities in foreign currencies, and we paid our claims in foreign currencies. We had an office in the UK and an office in Germany, and we had both euros and pounds going out in claims. Um, and so when it came to me, there's two questions, and I'll let you look at this problem so you can use your finance um, acumen to how you would manage a risk like that. So the first thing was we had assets, we had liabilities. The liabilities were reserves to pay claims in the future in pounds and euro. And so this part of the equation I could handle without too much trouble. We could forecast. I could go to the actuaries. I could look and see. Well, actually, these liabilities were also in the U.S. dollar. So I could look and see what our liabilities were, what we normally got in these liabilities, as far as what we expected our future payouts to be. There was some volatility. And then I would just make sure we had assets. We'd have investments to match the currencies of the liabilities. So that was my job. We actually hired a bond portfolio manager in the UK, You had background. In fact, it was interesting. The bond portfolio was being managed in San Antonio, and those portfolio managers came to me and begged me to get rid of that responsibility for them because they did not like having to do that. First of all, those markets were open at hours where they did not want to come in that early. But secondly, that wasn't a market they knew that well. And so I got approval to move that portfolio to a manager overseas. And what I do with that manager is I would tell them what allocation I wanted to our currencies, and I would send that to them every month. They did not have to match that exactly. I allowed them to do some currency management. If they thought the pound or the euro was going to strengthen or weaken, they had the right to do some on the edge, but we wanted it somewhat close. So here's my challenge on this. My goal was to reduce our exposure to currency moves. So I wanted to be in US dollars. So that was my goal, is to take these currency exposures and buy assets such that my exposure to pounds and euros would be almost zero. I would match up exactly. Unfortunately, the regulators required us to manage currency risk to the pound because we existed in the UK. So we had to actually manage our risk. So we were in pounds, but I wanted to be in dollars. And so that was my biggest challenge, is the regulators say we had to manage our currency risks so that we were exposed to the pound, and I wanted to manage our currency risks so we're exposed to the US dollar. So essentially what I did is I you know, I'm going to put this on a YouTube here, but I don't think I have any risk to this, is there was enough uncertainty, enough fudge factor in here that I could make it look like I was managing back to the pound when I really was managing back to the US dollar. There was enough fluff, enough uncertainty in the numbers. So I actually did that. We were never audited, or the UK has some pretty incredible regulators, and they're pretty actually very knowledgeable, but we never were questioned on this. And my goal was just to make sure that we were exposed to the US dollar. The problem is, and you'll see this on the mitigation, I was mitigating our economic risk, our economic exposure, but our CEO saw gap accounting, and that caused me tremendous pain and suffering because gap accounting does not in any way match economics. So our economic exposure was as close to zero as I could get it. So we were back in US dollars. Gap accounting for currencies is one of the most convoluted accounting pronouncements that is out there. It's so incredibly complicated, and there's almost no way to get it to work. Unfortunately for USAA, our currency accounting had its own line in the balance sheet so that our CEO would see all gains and losses. But some of the gains and losses were going through the income statement, some of them were going through the balance sheet, but all he saw was the balance sheet account. And I kept having to try to assure him, we've got it mitigated, but the accounting will not show it. I talked to our accountants, and they didn't understand it because they weren't really, it was such a small part of our business. None of them wanted to go out and learn this in detail. And so it was really quite painful, really, really frustrating. So that was the first thing we had to manage. I think we got it as good as we could get it. The second thing he wanted us to manage, so there's the first goal, and that one I could manage. I couldn't get the accounting and economics to match up, but I got it close enough, and the CEO finally caved in and said, okay, I just have to trust you that you've got it down. The second thing was to manage the customer's exposure to currencies. And this part of the equation, I worked really hard on, but I could not find a solution. But essentially what they were saying is our customers are paid in US dollars because they're US servicemen and women, but they pay us in euros and pounds. So what that means is if the US dollar weakens, what they pay us goes up. And so my CEO said he wanted me to mitigate that risk. He wanted me to make sure that if the US dollar weakens, we would not have to charge them more in euros and pounds. So you have to think about this. Yeah, we could do futures and other things to make sure that if US dollar weakened, we could keep charging our customers the same amount in euros and pound. So we could hedge a dollar weakening, but if the dollar strengthens, we would have to charge our customers more. There is no way using futures to get this to work out. So if I hedge the dollar weakening, then if the dollar strengthened, I have these large losses in my futures, we have to charge our customers more. So the only solution was options. I needed something that if the dollar weakened, it would pay off, but if the dollar strengthened, I would just lose the option premium. So that was a solution, except for the option premiums would entirely wipe out our entire Europe earnings. It would be so expensive, we essentially go to zero earnings in Europe, which they didn't want to do that either. So I could get that solution to work. While I was working on this, I was ready to go back to the CEO and say, I just don't see a solution here. I was told, give up, because the U.S. military pays a currency adjustment to our overseas military men and women, such that if the dollar weakens, they actually pay them more money. And so I said, well, we don't need a hedge. What I was actually told this, the president of the property and casualty insurance company called me and said, you don't need to work on this project anymore. The U.S. military is hedging this for us. We don't need to do it. That somehow that never got to the CEO of UTSA. And he found out a couple years later I wasn't working on this project anymore. He got really upset with me. I think he was ready to fire me. Fortunately, we all got that to work out, and my name was saved at the end of it. But very frustrating part of my career. Some of the worst few hours of my entire career was the big debate going on here. It was pretty interesting. We had exec council meetings where all the officers of USA were debating this, and no one really understood this problem. It was very frustrating. Finally, the CEO said, let me just meet with Ron one-on-one to figure this out. And I was like, yes, please, because the discussions were getting ridiculous. It's such a complicated problem. I don't like it. I don't like currencies. They're quite complex. However, I would tell you, if you like currencies, if you've lived overseas and you've gotten comfort with currencies and how they work, this is an area of specialization where you could really do well and make a lot of money in finance. So I would have hired you in my department in a second to take this over because I just did not like it. So anyway, there's our universal risks. That's the last one, currencies. The big thing here is value risk is how you measure it. Mitigation, you almost have to choose between mitigating it economically or with gap accounting, because those two just do not match. And so it's a frustrating one to manage. So remember, on the final exam, I'll do something along the lines where you have to pick one of the major risks. If you go back to our universal risk, way back up here, liquidity risk, and our very first one was interest rate risk. There's a lot of stuff back up here. You might forget that we covered all of this stuff. You had some of it on exam one, you had the interest rate risk. But our universal risk, we started with interest rate risk. We had three large risks: interest rate risk, price risk, and credit risk. So on the final, I'll ask you to pick one of those three and fully discuss them. By fully discuss, you define it. What does it mean? How is it measured? And how is it mitigated, including some editorial comments on the effectiveness of those. On your paper, you covered interest rate risk and price risk very, very well. The definition, measure, mitigate for your bank. So hopefully that will come back. And then on the other risks, all those other small risks that we have, and boy, there was a bunch of them. Liquidity risk was one. Basis risk, tracking risk, these smaller risks that we had. So basis and tracking risk, model risk, legal risk, disclosure risk. Operational risk was a large one, but I'm going to include it in these others. Tax risk, operational risk, and then currency risk, inflation risk, purchasing power risk. On the exam, I'll ask you to pick two, maybe three. I haven't decided yet. Two or three of these. Since it's open book, I might ask you to do three, and do the same thing. Define them. How are they measured? How are they mitigated? And so a way to come back and really summarize what we've done. We've done a lot with these risks, and I want you to know them very, very well and have at least a pretty deep understanding. I think paper one helped you a lot with price and credit risk, but let yourself this part of the semester sit down and let a few of these risks really sink in. So where we're going next is I'm going to take whom I think are the best thinkers in risk management. My favorite ones: Nissim Taleb, Kahneman, Duke, Annie Duke, and Doug Hubbard. Those are my favorite four. And what we're going to do is we're going to walk through them. With Nissim Taleb, we're going to look at some quotes from his book. With Kahneman, I'm going to walk through his main theories. Annie Duke, I have an entire PowerPoint that summarizes her book. And with Hubbard, what we're going to do is I have a video of one of the sessions he taught. I'm going to have you watch that video and ask questions out of that. So we'll start this the next week of classes. We'll start with Nissim Taleb, and for him, I'm going to have you walk through his quotes, and I have them sorted by different areas. And he wrote 4 books that I want to talk through: Black Swan, Fooled by Randomness, Anti-Fragile, and The Bed of Procrustes. I know he's written one other book here recently. I haven't gotten through that one yet. And we'll talk about what is it about Taleb that he gets quoted so often when it comes to risk management. So we're getting into, I think, the fun part of the class where we take this and say, okay, we learn all the basic stuff. Everybody does it. Now let's look at what people who are challenging finance, trying to get us to think differently, what are they saying and what do they have to teach us?